Hey everyone, it is Julie here with TipRanks, and today we're taking a look at 3 trending stocks. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 stocks that have been trending with analysts this past week, looking at the most rated stocks from the last 7 days. And not all of these ratings are coming in positively. We do have some that have been downgraded or a lot of holds coming in. So we're going to take a look at these companies, what's been going on with them lately, and how the analysts are weighing in on the stock's future potential. You can follow along over on TipRanks.com or by downloading the TipRanks mobile app in the link down below. Now let's get right into today's trending stocks. First up, we're taking a look at a company that has picked up 12 ratings in the last 7 days, with the most recent coming in just today. That is ServiceNow. They are a software company that provides enterprise cloud computing solutions to help companies manage digital workflows. They trade under the ticker NOW, currently priced at $7.60 per share, and they've seen some huge growth this past year, up nearly 72%, including 40% growth in the last 3 months. They'll be sharing their Q4 earnings report in just a couple of days, after hours on January 24th. Analysts will be anticipating earnings per share of $2.78, and that will be a 50-cent increase over last year's. In their Q3, they did come out with a notable earnings beat at $2.92, and they exceeded their guidance across all top-line growth and profitability metrics. They also raised their subscription revenues and operating margin guidance in that previous quarter as well. Ahead of this Q4 earnings report, we've had a handful of analysts not only reiterate buy ratings, but also increasing a lot of price targets. They're feeling pretty bullish for these quarterly results. One analyst from TD Cowen raised their price target to $765, saying that they previewed their quarter and that their partner survey showed a nice uptick in performance, with 71% meeting or beating targets, which was up 50% from last quarter. Another analyst from Citi said that they are positive on the Now stock and raising their estimates and their target price heading into the Q4 results after a solid round of post-Q4 partner checks. Commentary generally appears stronger quarter over quarter, with more lift from budget flush, better consistent bundling, and healthy 2024 pipelines. ServiceNow has 29 current analyst ratings and nearly comes in as a unanimous strong buy with just one hold. But even with all those buy ratings, the average price target of $765 is fairly flat from current prices, given the stock's recent growth. Looking down below, we can see the most recent ratings from this past week do have more upside potential here. On the high end, we have one price target from Needham with an upside of over 18%. But our average price target is coming in lower, as when we go back to October, a lot of our buy ratings have downsides, and the stock has shot well past those. Our second trending stock has also seen 12 new ratings in the past 7 days, but these ratings are coming in a bit more mixed. We're taking a look at Netflix. The popular online streaming platform trades under the ticker NFLX and is currently priced at $485 per share. Overall, in the past year, they're up 35%, including 19% in the last 3 months. This is another company that will be reporting earnings soon. Theirs is coming up tomorrow on the 23rd, and expectations are high. Netflix recently added that ad-supported level, and they've also been cracking down on password sharing. For their Q4, analysts are anticipating earnings per share of $2.21, and that is a large increase over last year's 12 cents per share. It will be a dip quarter over quarter, but is part of their normal cycle here. In the last quarter, they did come out with a big earnings beat at $3.73, coming in nearly 30 cents ahead of expectations. And when we look at this past quarter of website traffic, we can see that total estimated visits on all devices are up 20%. Analysts are weighing in on the Netflix stock ahead of this earnings report tomorrow, but we have a lot of mixed opinions. While several have increased price targets, we've also seen buys, holds, and sells. That includes a sell rating coming from Benchmark. However, they did increase their price target by $75. They still view Netflix's long-term business characteristics as more akin to other large media companies. The analyst says that the target change is almost entirely off conceding to our market-linked valuation relative to the NASDAQ 100 rather than the S&P 500. Their target reflects Netflix achieving near 430 million global members in 2033. In the middle, with a neutral hold rating on the stock, is an analyst from Rosenblatt Securities. They see an approaching question of substance. Their survey work suggests that the big lift to subscriber growth from the clampdown on paid sharing is likely nearing an end. And when that happens, what will normalized growth look like? And then we have a bullish buy rating coming from an analyst at Guggenheim. They said that they feel the analyst and investor narrative has seen a 180-degree turn from the cautious interpretation of CFO comments in mid-September to crowning the company as an unassailable media winner into Q4 earnings. Overall, the Netflix stock has 26 current analyst ratings, coming in as a moderate buy based on 17 buys, 8 holds, and 1 sell. And we have a wide range of price targets from $390 up to $600 for an average price target of $513, which would be an upside of over 5%. Looking at our most recent ratings here, you can see a lot of those mixed opinions coming in. We have our sell rating with a downside of 12%, a hold with a downside of 16%, and a high-end buy rating for Bank of America here with an upside of over 20%. And our third trending stock, also picking up 12 ratings in the past 7 days, is Discover Financial. However, they've been picking up a lot of holds, and we've seen some downgraded price targets. The direct banking and payment service company trades under the ticker DFS, currently priced at about $100 per share. They have seen some ups and downs this past year and are down 6.5% overall. In the last 3 months, they did grow over 22%, but have been cooling off here recently. And that recent drop in share price follows their quarterly earnings last week, where they did miss on expectations, with earnings coming in almost $1 short. For the fourth quarter, the company did report revenues that exceeded expectations. However, their earnings per share of $1.54 fell way short of the $2.49 expected. The company said that their provision for credit losses ballooned and that they wrote off a higher proportion of bad loans in the quarter. The company said that they did take steps to strengthen their risk management, and they also launched their cashback debit product and announced a new CEO. Following the quarterly report, we've had a lot of analysts lowering their price targets. That included one analyst at RBC Capital. They said that the company's Q4 earnings miss was driven by higher than expected expenses and provisions, though core trends generally benefited from the typical holiday seasonal strength. Their credit metrics continue to normalize higher, with losses likely to peak in mid-2024. One analyst from Bank of America said that they were not surprised to see the Discover stock selling off following the report. But they did say there were a few bright spots in the Q4 results, and the firm maintained their buy rating on the shares, arguing that with the stock being down 10%, much of the bad news is now reflected in the valuation. On the positive side, the rate of new delinquency formation is slowing, and credit losses should peak in 2024. Overall, the company is rated a moderate buy based on 8 buy ratings and 10 holds. With an average price target of $115, the upside would be 15% from current prices, and we can see a lot of hold ratings coming in here recently, including one downgrade from HSBC. On the low end, we have one of our hold ratings here with a slight upside of under 4% and a high-end price target of 26% from Citi. So that is a quick look at 3 stocks trending with Wall Street analysts, some for more positive reasons than others. Let me know your thoughts on these companies in the comments down below, and if you agree with those analyst ratings or not. Of course, please keep in mind these videos are never a suggestion to buy or sell any specific stock. Please make sure you always stick to your own investment plan. Thank you guys so much for watching. Have a great day, and I'll see you back here next time.